So the right hand side, you can already see how price played out. Here we're on the hour time frame. But right here, maybe thinking, okay, you know what, price may break above. You can't immediately assume that, but it does look like it will. But it's not lining up, right? Because if this little candle, this 30-minute candle gets taken out, then it's most likely going to continue going lower. So you can enter right on the break of these 30-minute candle lows, stop loss above these highs, because if price is going to move lower, it shouldn't go higher any longer. It should be going down from this point. You can already see there's liquidity sweep, went down, retracement, and then it's going to try to come down again to this point and possibly even to that point. But you should be looking at the first technical area, and then your second take profit should be the next technical area above or below that current point, depending if you're taking buys or sells. So in this instance, we're taking sells, so the second take profit is going to be the next technical area below this point, below that blue line. So next, you can see the bearish candle taking out this low here with strong volume. It closed with strong volume, no wick rejection. This is how you know you have confirmation. This is called confirmation. So you have your bearish confirmation for this sell setup now. Let's watch what happens next. This is exactly what you need to see. Absolutely beautiful. Now, price does look like it could hold this, but based on the higher time frame on our right-hand side, then we can go to the 4-hour, the 2-hour. When you're seeing those type of rejection candles, you can see here on the 4-hour, rejection right here, which is the high. This is that candle right here. And then we have the next 4-hour candle. Make another high and then drop, right? Made a strong wick rejection. That's what you need to see. That's your entry point. You're using the lower time frame to find these areas. Okay. Now you could also enter on the break of the support and continue lower, but this is how you catch the tops and bottoms. If you go to a lower time frame, like the 5-minute, you can clearly see that. Lower high, lower low, lower high, lower low, and you're entering on that bearish candle, on the break of that 30-minute candle low right here. You can enter right here on that little pullback because now you have your confirmation, and this is the retracement, and then you would have no drawdown and a push in your favor instantly, just based off timing. So now let's keep going. Another lower high point to a lower low point. Now price did pull back, but that's what happens sometimes. But on the 4-hour time frame, that was the high right here. That was a 4-hour candle high, my apologies. But either way, you would have had a little bit of drawdown, which is okay. You still have to trust your analysis. You accepted the risk. It's a high probability trade setup. You just have to be patient. You know, not always are you going to just snipe it and it goes in your favor instantly. Sometimes you got to be patient and it might come back a little bit. It might go in your favor a little bit before the move actually plays out. So now what happens next? Price ultimately comes down to that blue line, this area of demand, this technical area that we were looking at. Now you could enter here. This is the second attempt. You could enter here as well. But either way, you still caught the move, right? And based on the lower time frames, you can clearly see that this would be considered a liquidity sweep. There's a lot of people that were thinking, oh, it's bullish, it's going to hold on this level of support, and then it pushed up, faked them out, and then came down, right? But look at these candles on the 3-minute time frame. Strong bearish volume. This was strong bearish volume. Although this is a strong bullish volume right here, the context is not necessarily correct, okay? And you can see that based off the higher time frame. Price would never look like this if it was going to move bullish, okay? It's as simple as that. Then boom, you caught this nice move for, say you entered right there, had a little bit of drawdown, 30-point drawdown. That's literally pretty normal, especially on the NASDAQ. It's very volatile, and 50 points, 100 points realistically is what you should anticipate for a stop loss. Anything lower than that could be considered pretty tight unless you really sniped the higher low, or you really sniped the lower high point, the low or the high point, or you caught the breakout trade, the clean breakout trade, the clean impulse move. 30 pip drawdown, 30-point drawdown for a 140-point move. It's a very, very good risk to reward trade setup, and that's the kind of trades we're taking. Now, as you can see, bearish volume, bearish volume, bearish volume. You can clearly see there's more bearish volume than any type of any other price action. It's clearly outdoing all the buys. Okay, you have to look at these things in detail and understand what's really going on. What is the behavior doing? What is structure doing? What is price action doing? That's all it comes down to. And where is price reacting from? Is it reacting from these point of interest? Is it reacting from supply or demand? Is it reacting from support or resistance? Are you making lower highs and lower lows, or higher highs and higher lows? That's what it comes down to. Okay? So that's how you snipe the highs on certain areas. And remember, every single trade that I just showed came from a technical area. We didn't get in the middle of anything. You have to wait for these certain points, and if you miss it, that's fine. You need to analyze where the next possible move could come from, which takes patience. We don't FOMO into our trades. We do not just randomly hop in and hope for the best. You have to have a plan. You have to have these areas mapped up, and you have to understand the probability and context of these certain trade setups and price action, the market behavior. Okay, so now you understand or have a better idea how to catch these reversal trades. Now let's go back to the one chart, and we're going to look at counter trend trades and continuation trades. Now, the one I just showed you was technically a counter trend trade because the higher time frame was bullish overall, but the current behavior was bearish. Okay, but I can show you another counter trend trade. Now, I didn't take this, but this would be considered, we'll look at it right here, when price is already moving bullish, right? And actually, we're going to go to the point to where I had called the buys for the NASDAQ, and we'll look at that. Now, after this setup, I'm going to go to a different pair and apply the same exact thing so you guys can see that this works on any single asset, any single Forex pair, any single indices, any commodity like gold, silver, platinum, if you trade platinum, oil, it all works. Okay, technical analysis is a very, very strong skill set that you need to develop because it can be applied to all markets, including cryptocurrency as well. Okay, so we're going to go back to the two chart, the split screen. 1 hour on the left-hand side. We're going to let's exit this buy replay mode real quick. Right here where I called the buys first, right? This is a counter trend trade. This bearish candle on the 1 hour time frame, this one candle is a counter trend. And right after that, the bulls, the buyers stepped right in and completely outdid that. That's what a counter trend looks like. It's going to have a pullback, and then the continuation move will happen. Okay. So how could have one caught this sell? Now there was a student that caught the sells when I called the buys, but it was a short-term sell. Remember that counter trends are very short-term. You cannot be hanging out in them thinking to yourself, "Oh, I caught the overall move. It's about to have, a big 200-point drop." You can't assume that without price showing that. You can't do that without the market behavior showing that. Otherwise, it's just going to be a short-term move and you're just hoping. Okay? So how could one caught these sells? One, this was a lower time from liquidity sweep. Price made a wick rejection, came down to retest this area of broken resistance, now possible support, and this restructure was, because this is the higher low point. Zoom out on the 1 hour time. You can see push, pullback, which is the counter trend, higher low point, broke above resistance, higher high. Next, price could have continued up from this point, but at this moment in time, decided it needed to pull back first before getting enough momentum to break above this resistance and continue higher up to our overall take profit point. But you could have caught these sells as such. So let's go back to the 30-minute time frame. What do we see? Two strong bearish volume candles. And on the right-hand side, you see the 4 hour time frame. There wasn't really too much. Yeah, it made a wick, but was structure broken? No. Were any lows broken? No. And that's what it comes down to. Okay? So, 15-minute. Let's get some more details. I'm going to remove these previous risk reward tools so I don't get confused and so you don't get confused either. So look, wick rejection, pull back into this resistance, a retest, and then a move down. We're going to go a little bit lower, and on the right-hand side, we're going to go to the 2 hour. Okay, we're on the 5-minute time frame now. Really refining this data here. You can see right here is this wick. Now on this 2 hour time frame, this was a strong exhaustion. But on the 4 hour time frame and the higher time frames, it wasn't anything. Okay? Now right here, yeah, it did look like it could have been a reversal point. But on the lower time frame structure, because remember the market is fractal and you have to use lower time frames and higher time frames in conjunction with each other to get the overall correct context of the market. So you can see right here that the higher low point was never broken on the 1 hour time frame. Right now we're looking at the 2 hour time frame, but earlier when I showed you, this is the higher low point on the 1 hour time frame. The trend needs to continue from this point, from this area. Otherwise, if we break this bottom blue line here, it would have just tanked. The market would have just completely fell, okay? But it didn't, because the trend was still respected. So here, 5-minute time frame, strong engulfing candle. We see the wick rejection. We're thinking to ourselves, okay, there could be a pullback. Although I did say buy from here to here. I'll show you the little price range tool. It said buy from 128 to 1277 from this point. Now it did come down here, but that's fine. Like I said earlier, it's okay to have drawdown, especially if you already accepted the risk using excellent risk management and trade management, and you ultimately trust your analysis based off probabilities. So you can see this little lower time frame level right here. There's two ways you could have taken this. You could have anticipated this being the high based on the wick rejection, just entered. You know, that's okay to do. As, you know, in those situations you can use type stop losses and trade the momentum. Or you can wait for the little pullback, the little retest, which it did, based off the 5-minute time frame, okay? And you can enter on this retest of the resistance or on the break of the candle lows, just like as I showed earlier on the breakout trades. Okay, it's that simple. And that same entry method on the break of the lows applies to literally every single time frame. See, on the 5-minute it happened, when I showed you earlier, it happened on the 30-minute, and it happens on the 1 hour, 4 hour. You can see on the 2 hour it happened right here, broke above, then took off. You know, it happens on every single time frame. So that's when it comes back to understanding what type of trade setup you're taking based on the time frame you're taking it on. So you see the clean break right here, you enter, and you could have caught this move, I believe, for like 50 pips, 50 points. Yeah, 40, 45, just like that. It would have instantly pushed in your favor, no drawdown. That would have been a good counter trend move, okay? But you see, if you were thinking too big and going, oh, this is the reversal, you either would have taken a loss because you would have got stopped out up here, or you would have got taken out at the break even, or if you trail your stop loss, like how I tell my students to, trailing it down, you know, let's just pretend you move this blue line right here as a stop loss. You lock some profit in, the price came back and takes you out, you still secured a gain, and that's what matters the most at the end of the day. Excellent trade management is what trading comes down to. Risk management and trade management. All right, so as you can clearly see, on the lower time frame, that lower time frame level of support was broken right after you saw that retest of resistance and the candle lows being broken. That momentum stepped in and pushed the market lower. Okay, this very easy trade setup. It just takes context and understanding, and you also have to use discernment. You don't have to catch every single move, and in fact, it's not even possible to catch every single move. You can catch a series of moves, but you're not going to be able to catch every single trade, guys. There's just no possible way to do that because you're going to mistime it, you're going to take losses, you might make the wrong decision. Trading is meant to be done in moderation, and especially if you have sizable capital, you're not taking every single trade. You're taking 1 to 2 to 3 trades a day, a week, so on and so forth. So let's show one more counter trend trade for some buys and counter trend buys. And we're going to go to, let's look at gold here. Now let's find a good area where we could trade a counter trend buy setup. So we can consider this right here. I'm going to remove that risk to reward because that was from earlier today actually. But let's go to the bar replay mode. Back it up to right. Let's go to a little higher time frame. We're going to look right here, okay? Here on the right hand side is the 1 hour, but we're going to go to a 4 hour time frame. And where we're looking at is the price action in this area, in this ellipse, okay? So now on the right hand side on the 4 hour, you can clearly see we had a rejection and then another rejection and a bearish move. But in the lower time frame on the 30-minute, where we're at now on the left, and dropping down to the 15-minute, you can see that there's some bullish price action still. There's more details, but the higher time frame doesn't show those details, which is what makes this a shorter term trade, a short-term counter trend trade. Okay, back to where we were. Next candle, next candle, next candle. Look at this. It comes back to taking trades from our technical area. So we have an area of support here. Look, we can see price is trying to hold this area, make a lower high point. It's in a tight little range and it's trying to decide what to do. So to stay safe, you can either take the buys when it breaks above or take the sells when it breaks below. But if you're looking at the lower time frame, you're able to gather more details. So you can see on this 15-minute time frame, we have that strong this strong bullish volume candle based on the 15-minute time frame. Okay, you can target this area of resistance as your first take profit, and you can also use this little area here. Because remember, counter trend trades are short term. You're not trying to catch some huge move. You're understanding it's a short-term trade. It's not that big of a move, which makes counter trend trades risky because you end up thinking you caught the reversals or the highs or the lows, and then you hold on too long and you either lose or get out of break even. You see on the 5-minute, now you could have entered right here on this little pullback on the 5-minute, but we're looking at the 15. The next candle should pull back, probably right to where this risk reward tool is, and then it's going to hit this point, and then most likely hit this point before deciding if it's going to continue higher or make a wick and go down and go lower and break this area. And on the right, you can see that's what happened, okay? But we're looking at the left right now. Let me drag this ellipse a little more. Okay, so let's look what happens next. All right, strong bullish impulse candle. Here's our entry. Boom, sniped it, literally sniped it, no drawdown. We sniped that, we caught the low. We're targeting right here and up there. Okay, let's see what happens next. All right, nice. You could have closed right there, okay, because remember, it's a counter trend trade. This would have been 30 pips. That's pretty good. That's a really good move. Like literally, you could have called it a day. On a 5 lot, on 30 pips, that's $1,500. On 1 lot, that's $300. On a 0.1, that's $30, okay? That's a really quick trade in 10 minutes. All right, counter trend trades are quick, but they are more risky. So after this point, after pushed up like that, you're going to go break even, and you can let the trade play out, or you could have closed. We're seeing a pullback right now, and all right, break even would have been if you did not close to that 30 pip move. Now, what I recommend is either taking partials or just closing all together because you understand it is a counter trend trade. 30 pips is a lot to make in 10 minutes, and it comes down to using your own judgment at the end of the day. But let's see what happens next. All right, so price broke that time. But as you can see, we had a point in time to close for 30 pips. And this is what makes counter trend trading so risky. Okay, because yeah, price in theory could have went up here, but ultimately didn't, and you had to adapt and manage your trade. And you could either take profits or just trail the stop loss to break even. But ultimately, it broke lower and broke below this point of support to make it happen. Okay? Now, this would have been what? If you paid attention to the first part of the video, this is a breakout trade. Really nice breakout trade set up for sells. Okay? Break at the low, stop loss above the lower high point, ride the momentum down to the next technical area. And look what happened on the right-hand side. That's exactly what happened. Now, a lot of these things all tie in together with each other. And it comes down to your own understanding and experience to be able to piece that together. And that's what I'm trying to show you guys. There's multiple different trade setups. And a lot of them are high probability. It's learning to consistently use the high probability setups, which is why you need a playbook. So if you need some help and need some additional guidance, consider joining my mentoring channel. It's not expensive. I'm not out here charging an arm and a leg. It's $15 a month or $90 lifetime. It's not expensive. A lot of people are out there charging $1,000, $200 a month, $1,000 lifetime, $500 lifetime. You don't need to pay that much to learn how to trade. You really don't. But what you shouldn't be doing is just navigating through YouTube and learning all that you can. That's going to make you lose. Trust me, I've been down that road too. YouTube University, learning about RSI and Ichimoku Cloud, just a bunch of bullcrap that's out there that's not going to help you in any type of way. So that was one counter trend trade, and I know this video has already gone on longer than I said, but this has a lot of information for you to help you succeed, which is why I'm making it. So they see the move, they see the trade, but they don't know how to enter, they don't know how to execute because they don't know what needs to happen. So a lot of times they're just waiting patiently and the move leaves them because you're waiting for something perfect to happen. Or you're just scared because of your lack of understanding. You're scared to execute, which you cannot be scared to execute, especially if you're just trading a demo account. That's the point of a demo, is to learn and execute and get better at trading. I can understand if you're trading your live funds and are scared to execute. That's fine. But at the end of the day, that's how you're going to learn, by application. All right, so we're going to go over one more trade example, just simply because, as I said, this video's gone on a little too long. But it is going to help everyone. Lastly, we're looking at continuation trades. Continuation trades is trading with the trend, with the momentum, with the overall higher time frame. Okay, so that'd be off the weekly, off the daily, so on and so forth. Let's remove some of these technicals that I applied for the last example. And some of you have asked me this as well, how I'm quickly switching through the time frames on TradingView. If you're full screen, you don't have to keep, exiting and going full screen to change your time frame. You literally can just push. For example, I'm going to go to the 2-hour time frame. That's simple. I'm going to go to the 5-minute time frame. Type in 5 minute. You don't have to, exit full screen or anything. You just literally type the number on the screen. 3 hour, 3H. It's that simple, okay? Hopefully that's a helpful tip for you. That was really helpful for me when I learned that a few years ago. Overall trend. Now, it's a little tricky to time some of this because, it comes down to timing most of the time and patience. And sometimes you got to wait for that liquidity sweep to happen before you can execute with the overall trend. But for example, let's go right here. Now, obviously, this is a very big move. This is a higher time frame move, and with the overall trend, this went for 600 pips. Now, I did not catch this trade, but this is how you catch them. Usually, you need to wait for a break of structure or a market shift or something to happen for the overall market behavior to change. You need to wait for the overall market behavior to change. This point right here, I'm going to label this line as a break of structure. This is a lower time frame break of structure. Okay, break of the highs. You can consider this a breakout trade too. Remember, everything I'm showing you right now all goes hand in hand with each other. Lower time frame break of structure. Remember, if you're catching the reversal trades, the highs and lows, you could have sniped it on the lower time frame here. But right now we're looking at the 2-hour time frame. We're looking at this price action here in the ellipse. To split screen, we're on the right hand side, we're on the 1 hour. On the left hand side, we are on the 5-minute time frame. Let's get off of this bar replay mode here. And let's go to the price action in the ellipse. So what do we see here? See that price made that strong low point, pushed up, came back for a retest, which is a higher low point here on the 1 hour time frame on the right hand side. Wick rejection, price never came back. Retested this area of demand and area of support. And then we had a strong bullish volume candle. Here's your first clue that price wants to start moving bullish, okay? If price was going to move bearish and go down, this bullish candle right here would have never outdone the previous bearish candle. That's how you know it's not a sell. That's how you know it's not bearish. It would never do that. It would need a respect from the halfway to the opening price right here. From this point to this point, price needed to reject and go down from. But the fact that it closed above it and broke above, you need to immediately assume, or not assume, but immediately switch your bias and your thinking into going, all right, I don't think it sells anymore. This might be the low point. We see a strong wick rejection here, liquidity sweep. This trapped a lot of the sellers thinking that this level was going to break. And then it happened again. These sellers got in right here as well because they saw a strong bearish volume candle. but that was not in line with the overall context of the market behavior, okay? Or the market structure. So depending on how you wanted to take this trade, continuation move right here, right on the higher low point, stop loss below this point right here, this higher low. Okay, your stop losses are typically based off structure or the previous low or high, lows or the high. Okay, it depends on what type of trade setup you're taking. Remember, it all goes back, it all goes hand in hand, it all goes back onto each other. Higher low point would have been a very nice move right here. You could have literally just closed the trade on that candle. On this 1 hour candle, it pushed for 320 pips. You could have called that a week, could have called it a day off. You very well should have called it a day. But you could have called it a week. You could have called it a month. Okay, on a one lot, that would have been $3,200. On a 0.1 $1 a pip, that would have been $320. On a 5 lot, that would have been $15,000. It was almost $17,000 actually. $16,000, $17,000 on that one trade on a 5 lot on that one candle in 1 hour. Okay, so now let's refine a few things on the 5-minute time frame. Let's go back to the bar replay mode. On the right hand side, you can clearly see the price action, but on the left is going to be the bar replay mode on the 5-minute time frame. You can see that price made a higher low. This lower high point on the 5-minute is meant to trick you. It is not lining up with the overall context. This is a counter trend trade. Now, if you would have caught this little move for a counter trend, that's fine, but you cannot stay in thinking that it's the overall lower high point is about to move strong bearish. No, that's not correct. Remember, everything's based off of the time frame you're seeing the move on. So why would you think that a 5-minute lower high point is going to outdo the higher time frame bullish context that's currently happening? It's not going to, unless structure breaks. But structure just broke to the upside, so it's not going to break structure again. It doesn't do that. The market does not do that. Now, the market does crazy things and gets volatile, but it doesn't break structure, then break structure again. No. So let's watch. Boom. Right. There you go. You would have sniped that low if you could have bought on that support. If not, okay, although it's very ideal to get those wick entries, you literally could have bought on the break right here as well, which comes back to a breakout trade or break a structure trade. You know, it all comes back to each other. It's just understanding the context of how to apply these certain setups to the situation in the market. Buy right here. Let's move this over some. Buy right here on the next candle. Okay, we entered. Price pulled back a little bit. Price moving bullish. Came back down. We're still good. Boom. See? We're fine. You have to trust what you see and manage your risk. Never would have got stopped out. You can clearly see right here. Nice, clean impulse trade. Break of the highs and took off. And then the rest is history. Let's keep clicking. Another higher low point. Slight pullback. Counter trend trade. You could have taken that. Just a short-term counter trend trade would have taken 10 minutes. But you cannot get trapped in that. You cannot stay in those counter trend trades assuming and hoping you caught some big move. You have to trade with the trend if you're trying to catch these bigger trades. Or catch these break of structure moves. Okay? As you can see, we would have closed. But if you didn't want to close, and as I was saying, you're targeting the next technical level, which is this area of resistance. In this instance, you'd go break even, drag your stop, trail your stop loss. So let's say on this move, you went break even and you're still anticipating it to go higher, and you see this higher low point, you'd trail your stop loss below that bullish candle as it keeps moving. And this move happened right here. Could have moved it up right here or here, still securing more gains along the way, which is the whole point of trading, making money. You got to take your partials. So, okay, if you do not close for that big 320 pip move and you trail your stop loss where this blue line is, and you would have got taken out in a profit for a total of 140 pips. Now, some of you out there might be like, oh, wow, I just let go so much. Yeah, that's true. You let go of, almost 200 pips, but you just caught 140 pips as well. So this is where it comes down to studying and back testing and getting better. Because had you recognized this and understood not to be greedy and been disciplined, you would have closed, okay? Or you would have fully accepted that, okay, I'm seeing this overall bigger move. I'm content if price comes back and takes me out at this trailing stop loss because I know I have profit secured. I know that I managed the trade effectively, and I know that I could possibly re-enter if this takes me out from this point. So you're taken out. Next candle. All right, let's watch. So this, I'm going to move this point. You could possibly re-enter the same exact trade. So you see that this little area of support is here based off that previous higher low point. You're going to still target the same area. Now your stop loss could either be at the same point or slightly below right here. Now this is pretty tight, but in theory, price needs to continue from either this point where it's already at, or it's going to retest where it broke structure really quickly, just wick right there and then take off, okay? Either one. So it comes down to patience and also your risk tolerance. There's nothing wrong with entering here. There's nothing wrong with possibly waiting for it to come back down and entering there. But you have to adapt to what you see, and you have to accept that, okay, if this takes me out, we could buy down here, or if it doesn't take me out, then we're fine, we're golden. No pun intended, since we're on gold. But yeah, see, clear higher low point right after this, on this 5-minute candle. Right after that bullish move, you instantly go break even. Don't even mess around. That's what you have to do. This is what the professionals are doing. Boom, we're secured. If price wants to come back, we're taking out break even and we can re-enter. Or if price wants to continue, we're good. It's going to keep on going. Slight pullback. Could have entered on that. Yep. See, could have entered right on that candle as well. Scaled in right there. Took another entry. And if you want to learn how to scale in, you can watch this video right here. I have a 2-part video series, and I try to scale in on most of my trades, especially if it's like setups like this. You cannot scale in on every single move because sometimes you might scale in too deep, and it's just a counter trend trade. And then you have to make a quick decision to either take the small gains, close all the positions quickly, or you could take a rip if you didn't manage the trade effectively. Okay? So scaling in takes experience, and I do not recommend it unless you already have a solid trade setup, solid trade strategy, and understand how to enter with multiple positions, which I fully walk you through in those videos. So next, you have that next entry point, almost no drawdown, and guess what? Price continues all the way up to where we were anticipating. Now there's some consolidation here. It's moving a bit sideways, but we're still fine. Okay, our first entry down here, break even at this entry point, just floating around. You could have reduced it a little bit after that point, after this point right here, or break even. This one's in profit at break even, or you could have trailed it right here. You would have trailed from your first entry, your stop loss right here, where your second entry is, and now you have your second entry at break even. So no matter what, you're still making money, and you have more risk on to potentially make more if price wants to continue, which it does, as we can clearly see next. As you continue moving, price is making higher highs, higher lows, making counter trend trades, making counter trend movements, and then pushing with the overall trend up until we get to, I'm going to go to a higher time frame so it doesn't take as long, but up until we get to that area of resistance. Higher highs, higher lows, higher highs, higher lows. And you can see these little counter trend movements trying to trap these sellers, trying to catch the high. But in reality, those sells are not valid because we're not at a technical area. We're in the middle of the chart. If you're going to take a sell, it needs to be from that technical point up here or on the break of this support down here. There is no reason for you to take a sell and then ultimately be like, it's going to go down. It's going to go all the way down to here from this point. That makes no sense at all. You need to trade with the trend, especially if there's no technicals in between. It's going to go to the next area. And here we go. Came back and made a higher low point based off the higher time frame, and then boom, hit that area of resistance. This whole time that you're managing this trade, you would have, 1, never been stopped out on that second entry. 2, where your trailing stop losses, where this blue line is, would have never been hit. And on top of that, you would have caught a massive move for 300 pips from that second entry, and from that re-entry right down here, 400 pips, okay? That's literally how it is. It's not as crazy as it seems. The confident trader makes the most amount of money, and the stronger understanding you have about the market, about liquidity, about structure, about price action, is how you're going to consistently find and take advantage of these setups. It's not going to happen overnight. It's not going to happen in a few months. And it could take a whole year or more for you to be able to get self-sufficient and see this for yourself, which is why it takes so much work and discipline and practice to get to this point. I've been trading 5.5 years now. This didn't happen overnight. It took almost a whole year just to learn the right information because I finally got a mentor and got a course that was actually viable. There's a lot of garbage out there, guys. But if you focus on the right things, like what I'm teaching you, I consider this to be right. This is how I trade. I don't see any other way being as effective as this. Okay, and that's just me. Some people don't have to agree, but at the end of the day, professional traders are trading price action and structure, and that's what it comes down to. I know this video went on for a while, but it was packed full of information, fully to help you out, and on top of that, I believe we both learned a lot in this session. So if you enjoyed this video, go ahead and give this video a like, subscribe, don't forget to follow the Instagrams at BuildATrader, at BAT Signals, and if you need additional guidance, join the BAT Signals free Telegram channel. Now, I don't call any more signals in the free channel because a lot of you guys just don't know what to do and are inexperienced. But if you want the trade signals that I'm calling and my own mentorship and the BAT all-inclusive BAT trading guide and the BAT playbook, you can literally purchase my mentorship. It's only $15 a month or $90 lifetime. I'm not going anywhere. I've been running this channel for a year and 3 months now. A lot of students have grown and learned a lot, and we're growing together as well. But that's all for today, guys, and I hope you have a great week and a solid, profitable week, and I'll see you guys in the next one. Peace.